Evolution of stock market. Stock markets are constantly at the forefront of both recessions and booms. Reviewing the evolution of stock markets reveals that markets are as personal as the individuals who trade in them. But how did stock exchanges emerge? Hi guys, welcome to my YouTube channel. In this video, we will look at the history of stock markets, from the first stock markets to the present day. However, before we go any further, make sure you subscribe to this channel and don't forget to hit that bell icon so you never miss any updates. Now without further ado, let's get into this. What is stock market? Stock markets are among the most significant components of today's global economy. Stock markets are key to economic progress in countries all over the world. The stock market is a group of marketplaces and exchanges where routine transactions such as buying, selling, and issuing shares of publicly traded corporations take place. A country or region may have many stock trading venues that allow transactions in stocks and other kinds of securities. The New York Stock Exchange, Nasdaq, and Chicago Board Options Exchange are the three most important stock exchanges in the United States, since it is recognized as a stock market or money market and is mostly known for trading stocks and equities. The stock markets also trade other financial assets such as exchange-traded funds, corporate bonds, and derivatives based on stocks, commodities, currencies, and bonds. Venice's real merchants. The European moneylenders filled significant gaps created by the major banks. Moneylenders exchange loans. A lender wishing to offload a high-risk, high-interest loan would trade it for a different loan from another lender. These financiers also purchased government debt. The lenders began selling debt issues to the first individual investors as their firm evolved naturally. The Venetians were pioneers in the sectors, and they were the first to begin trading government securities. The world's first stock exchange without stocks. According to our analysis, Belgium had a stock market in Antwerp as early as 1531. There would be meetings between brokers and moneylenders to discuss commercial, government, and even individual debt difficulties. It's strange to imagine a stock exchange that only traded in promissory notes and bonds, but there were no genuine stocks in the 1500s. There were many different types of business financiers, partnerships that generated revenue in the same way that stocks do, but there was no formal share that traded hands. East India Companies. Companies named East India were granted charters by the Dutch, British, and French governments in the 1600s, except for the people who lived in the East Indies and Asia. Everyone had a share in the revenues from the East Indies and Asia during the height of the empire. Aside from the threats of the Barbary pirates, sea excursions were fraught with other dangers such as bad weather and poor navigation. Ship owners used to look for investors who would put money for a ship's journey in exchange for a share of the profits if the voyage was successful. Investors diversified their risk by investing in a number of different businesses at the same time, increasing the probability that none of them will fail. These early limited liability corporations usually only survived a single journey. The formation of the East India Companies altered the way commerce was conducted. Rather than traveling journey with voyage, these businesses issued shares that paid dividends on all of the earnings from all of the voyages they conducted. They were the first joint stock businesses in the modern era. As a result, the corporations were able to demand higher prices for their shares and create larger fleets. The company's scale, along with royal charters prohibiting competition, resulted in massive gains for investors. The South Seas Bubble bursts. A government-backed monopoly gave the British East India Company one of the most significant competitive advantages in financial history. With a similar permit from the emperor, the South Seas Company was formed, and its shares were traded as soon as they were published. The SSC had used its newfound investor riches to establish luxurious offices in the finest areas of London before the first ship even left the port. Because the rising financial boom in England happened so swiftly, there were no laws or regulations governing the issuance of shares. Some of them were ridiculous, such as regaining sunlight for veggies or guaranteeing investors shares in a project so important it couldn't be disclosed. The SEC's failure to pay dividends on its small revenues caused the bubble to burst, demonstrating the disparity between this new share issuance and the British East India Company. The government outlawed the issue of shares as a result of the subsequent fall, which lasted until 1825. The New York Stock Exchange. 1777. The New York Stock Exchange was established 19 years before the London Stock Exchange. Although the Philadelphia Stock Exchange was the first stock exchange in the United States, the NYSE swiftly rose to become the most dominant. The LSE was bound by the rule prohibiting the trading of shares, yet it has been doing so for more than 200 years. Under a spreading boughs of a bottomwood tree, a group of traders created a New York Stock Exchange in 1775. More than anything else, the NYSE's locations contributed to its rapid boost in popularity. It served as a hub for all commerce and trade entering and leaving the United States, as well as the domestic headquarters for major banks and significant enterprises. With the growth of the American economy, its worldwide standing grew and it quickly became the most significant in the world. During the same period, the NYSE saw its own ups and downs, including the economic depression and the Wall Street bombing in 1920. Competitors of NYSE. London emerged as Europe's primary stock exchange, although many businesses who were eligible to list worldwide continued to do so in New York. Many other countries including Germany, France, the Netherlands, Switzerland, South Africa, Hong Kong, Japan, Australia, and Canada established their own stock markets, but these were mostly used as proving grounds for local companies until they were ready to go to the LSE and then NYSE. Because of weaker listing criteria and less strict regulatory supervision, some of these overseas exchanges are still considered risky areas. Despite the existence of stock exchanges in Chicago, Los Angeles, Philadelphia, and other major cities, the NYSE was the most prominent stock exchange, both domestically and internationally. However, in 1971, a competitor appeared to threaten the NYSE's dominance. New York Stock Exchange dominancy till now. The New York Stock Exchange, or NYSE, is still the world's largest and perhaps most powerful stock exchange. Although Nasdaq has more businesses listed, the NYSE's market capitalization is more than that of Tokyo, London, and Nasdaq combined. The New York Stock Exchange, or NYSE, which was historically strongly linked to the fortunes or failures of the American economy, is today a worldwide market. Despite the fact that other stock exchanges across the world have become stronger as a result of mergers and the growth of their domestic economies, it's difficult to see how any of them will be able to overthrow the 800-pound gorilla that is the New York Stock Exchange. That's all for today's video, and thanks for watching it. If you like it, make sure you give it a thumbs up and share it with your friends. Also, don't forget to share your thoughts and valuable feedback with us in the comments section below. Lastly, if you have not already subscribed to this channel, subscribe to it and press that bell button so you will be notified each time we upload an interesting video on this channel. And while you're here, click to watch one of these two videos that are appearing on your screen. We'll see you there. Take care and stay tuned.